Hello and welcome to Future Generation Investment Insights. I'm Caroline Gurney, CEO of Future Generation. Today I'm joined by John Coombe, who is an Executive Director at JANA Investment Consulting. John is on the investment boards of both Future Generation Australia and Future Generation Global. He does that on a pro bono basis, which means shareholders get the benefit of his advice that he would normally be giving to super fund clients. All of our underlying fund managers, service providers, our boards, the IC, provide their services on a pro bono basis. Other members of our investment committee include Jeff Wilson, our founder, as well as other well-known individuals from Morningstar, Longsec, the founder of Zenith, to name but a few. Their collective generosity allows the future generation companies to generate investment returns for our shareholders and also make a social investment in high-impact not-for-profits. We give 1% of our assets to not-for-profit organisations that support children and youth at risk and to the prevention and well-being of young people's mental health. So far, Future Generation, both the companies, have donated $65.2 million, thanks to the ongoing support and generosity of people like John Coombe. So John, welcome. Thank you so much for spending time with us today.
Thank you, Caroline.
So tell me, what is your day job in your own words? Like, what are you doing on a day-to-day basis?
Oh, everybody asks me, especially my kids when I was at school. They were at school and you had to do those presentations. But look, I have one of the best jobs in the world because I get to look at financial markets on a daily basis. I get to look at macroeconomic trends that are happening, get to read and listen to the best minds globally. We're in a very privileged position as the largest institutional consulting firm in Australia that, you know, all of the fund managers globally come and see us, all the domestic managers who want an institutional mandate come and see us. So I do get to speak to some of the, you know, the brightest and best investors in the world on a weekly, daily basis, so it's fantastic.
I think on the investment committee, we are very grateful for your expertise. But first of all, let's talk about markets. I have a number of questions from shareholders as well, so I'm going to be referring from those because obviously we do our webinars on a very regular basis. You know, it's a really extraordinary time at the moment, and history doesn't necessarily repeat, but it often rhymes. What period, the period that we're going through now, what does it actually remind you of? And can you help explain what is happening at the moment and how to navigate that volatility? What are you telling your super clients?
Wow. I don't think there's anyone alive investing today, maybe Willow might be there, but who's ever been in a period like this. I think it's unique, right? And let me go back in history, probably after the Second World War, because I've read a lot of historical economic material, trying to get my mind around this. Some people have likened it to after World War II, and there was a spurt of inflation, there was a lot of employment, etc., and governments were spending a lot, particularly on, you know, people coming back from the war. But then you've got to sort of throw in the 1970s where you have an energy crisis, and so you've got this energy spike caused by the Russian invasion of Ukraine. So it's a mix of those, but the world's a completely different place to back then because manufacturing was on the up in the US. Manufacturing is sort of non-existent in the US. It's a service economy. And yet we've got this inflation bout. And so you really got to, it's quite unique. And if you really think about it, we started off the 2020s, really low interest rates, booming stock markets, etc. Then we go into the pandemic and suddenly interest rates that we thought couldn't go any lower went lower. Government expenditure just exploded. And suddenly we came out the other end when the vaccines came in, excess demand, inflation, and suddenly central banks have had to reverse everything. And suddenly we've got interest rates, you know, short-term interest rates are 4 times higher than they were a year ago. Long-end interest rates are 2 times longer. And suddenly the stock market goes, oh, hang on. we've got to adjust to this whole new regime. And so we've seen real big declines, and in some markets like NASDAQ, some stocks are down 80%. So it's a really unique point in history, and it'll be interesting when we go into 2023, when interest rates may peak, what the markets do after that.
You mentioned obviously that it's an inflationary period. What are super funds actually doing at the moment in this time, and how can we use that as to give some lessons in a way to our investors?
Yeah. So super funds are typically looking for investments that protect against inflation, and so they've looked for assets that historically have provided inflation protection. So that's typically been property, adjustments in commercial rents for inflation, infrastructure, although when we say that, there is no real history about how infrastructure does perform, but we know that there's inflation protection there. And then they look at stock markets and go, well, what companies in the stock markets have typically delivered protection? And it's generally been the high quality names where they've got pricing power, etc. And so you've seen the investors looking at their mix of managers to make certain that they've got quality in their mix.
So I've spoken to a number of our future generation fund managers, and there seems to be very much a sort of a mixture of patience and the need to actually take advantage of this volatility. This period, personally, I would think is great for stock pickers at the moment, because something that might have been too expensive is now probably in range. You've got to be careful of picking the right opportunity, but does this volatility also give, mums and dads and others opportunities?
Absolutely. And there's a great opportunity within our own fund where they're trading at discounts, right? So if you...
I didn't prompt that.
I know that. And that wasn't supposed to be the answer I gave, I think, anyway. But that is an opportunity, right? So you've got to look around and go, well, what's trading at discounts to underlying valuations? And LICs, some of the LICs are trading there, and we're one of those. So that is an opportunity. But in a general sense, I think investors need to be cautious because we may not be at the bottom yet of this. We haven't had the earnings. We haven't seen markets and participants in markets give warnings on earnings outlooks going forward. In inflationary periods, earnings get hit. Corporations have levered up their balance sheets, so by nature, interest rates are going to impact on their bottom line. Wages and salaries are rising. Input costs are rising. That has to impact on earnings at some point into the future. But for stock pickers like our guys, that's a great opportunity to reposition portfolios. We have some managers who, in January last year, I know one in particular who turned over 40% of his portfolio to reposition from where he was to where he thought the markets were going. We've got others that were, are probably topping up on some of their better ideas because the market's given them an opportunity to buy where they didn't think they had it.
So I think you've given me the perfect segue into Future Generation Australia. I mean, currently the portfolio has 18 fantastic, boutique fund managers investing Australian equities, and we've got 21 funds there. So that's a very diversified portfolio. Tell us a little bit about that diversification from an investment committee point of view.
Well, we have guidelines. So we've basically established that we want to protect our investors, particularly the mum and dad investors, from real downturns in markets. So we've got some absolute managers, some market neutral managers, and some long only, real stock pickers. We've got a reasonably heavy weighting into managers that, are real stock pickers, don't care about the index, just want to pick the best stocks. And we have some ballast in there, where we've got some managers who basically aren't looking to shoot the lights out, from month to month, year to year. So I think we've got a really, really good mix of trying to protect for downturns, but also capturing a lot of the upside when it comes.
So we talk about long equities, we talk about market neutral, we talk about absolute bias. Why is it really important to have funds that work to this sort of investment style within our portfolio?
Oh, again, I think you don't want to be caught, and we've seen that just recently in the last market downturn. If we'd followed the trend and just had all growth managers, we would have done quite well in the last 2 years up until probably September last year. But it would have been an horrendous year this year. We'd be down under the market by 10 or so %, right? So because growth has fallen out of favour as interest rates have risen. That's why we have a mix. That's why we try to protect. We know that markets, on average rise, but we also know that they have big drawdowns. And so it's a matter of trying to have that real mix, I think, Caroline.
So, John, let's look at the performance of Future Generation Australia. How do you deal with negative performance?
Yeah, look, the last quarter's been good, but prior to that, we had a tough period because we're overweight small caps, and that sort of impacted the performance as small caps underperformed. But in the last 3 months, that's turned around. So we're pretty comfortable when you look in the longer term numbers. We're well over 3, 5, and since inception. So it's just one of those things, sometimes the markets treat us poorly. We've had other periods like this before where the small caps have underperformed, but they've bounced back, and we rely really on the stock picking ability of the managers.
But that seems to have corrected now in the last 3 months.
Yes, it does look like that, Caroline.
And what do you think is unique about the Future Generation Australia portfolio?
Oh, just the amount of stock-specific risk in the portfolio is very unusual from an institutional point of view. We look at a lot of institutional portfolios. There's nothing quite like our portfolio in terms of the number of stocks, and yet the degree of stock-specific risk or ability to outperform by holding those specific stocks. And it's really unique.
So let's turn now to Future Generation Global.
I knew you were going to go there, yes. Caroline.
So, in terms of global equities, yep. There's a lot of underperformance across the board. Yep. What's happening globally? Why there's hardly any good funds at the moment performing well across the board? Yeah,
and Russia's the thing that's caused that. The Russian invasion of Ukraine took the markets by surprise, and the cutting off of energy and the increase in energy prices. We were at 60 odd dollars a barrel a year or so ago. We're near 100 today, and we've been over 100. The threat of cutting off supply to Europe, the impact on the European stock market. You've seen all of the trouble in Europe. You've seen the trouble in the UK. Part of it's their own making, but all of that is not predictable if you're a stock picker. And so a lot of managers were underweight the energy companies because if you think about climate change, etc., what's their future? And so a lot of them were overweight other parts of the market and really underweight that. Well, those stocks just took off in the first half of the year. And so a lot of managers, whether they'll value or growth, underperformed dramatically.
So even, we talk about diversification, the Future Generation Global portfolio is diversified, but it hasn't performed as well as we would have expected. Obviously, we don't have that much in terms of energy stocks in there, but why else hasn't it performed?
I think some of our absolute return managers and our long short managers haven't done as well as we would have hoped. and we've been quite disappointed in some of their performance, and that's part of the reason why we're doing a little bit of restructuring at the investment committee.
So the investment committee has been meeting incredibly regularly.
Yes.
So how are you rebalancing the portfolio?
We're adding more managers. We're downweighting some of the managers that we've been very disappointed in, and we're improving what we think the mix of management going forward. We're going to reduce our risk across the portfolio, and I think we're introducing some really interesting managers. Some of those managers are managers that we have in FGX who have moved into the global space, and we're taking advantage of our knowledge of them and the way they've run their assets here in Australia. And so we're basically looking to introduce those guys in a way to dampen down the volatility and improve our net returns into the future.
So we now have 14 boutique fund managers in the portfolio, and obviously we've just introduced Plato, Lanyon, Vinva and Holoisco. So tell us about those, because obviously Vinva is from the Future Generation Australia portfolio. So Plato and Vinva, I mean, they're sort of quant. Why is that going to be good for the portfolio?
It will dampen down our volatility because it'll give us more stocks basically across the portfolio. They're more index aware, as quants are, but that doesn't stop them picking stocks or, moving the portfolio around. It just basically means that they're more risk controlled. They take a little bit of the risk out in terms of sector bets and country allocations, and so that's a good thing for the portfolio. It gives us a more rounded portfolio. So we're in, I think, really good managers there who we've had really good experiences with. Vinva in particular have a history of, Maury Wakehead was head of BlackRock's global portfolio team before he left BlackRock. So he has an experience in global equties.
So tell us a little bit about Holoisco and Lanyon as well, because obviously Lanyon is also in the Future Generation Australia portfolio.
So Lanyon's unique in a sense because they're very concentrated portfolio, but with a true valuation bias. We've probably lacked that in the portfolio. We've probably had a little bit too much growth in the portfolio. So the introduction of him into the portfolio is going to be quite interesting from our perspective. We've put him in at a modest way because it's a new strategy. Mark Holoisco used to be the head of Franklin Templeton way back in the late 90s, early 2000s. He was one of the reasons why in the tech wreck, Franklin Templeton did so well. And Mark decided after those days that he would go out and start his own funds. He's been a very successful investor in long-short portfolio for 20 years. I think we're just so fortunate that Mark wants to give back to Australia and is happy to be a manager in the lineup. It was really inspiring when we did the interview with him that was really one of his big focuses, was that he wanted to give back to the Australian community because Australia had been really good to him. He's had long-standing relationships with some of our clients. He has performed as you would expect for a long biased absolute manager. He's done particularly well over a very, very long period of time.
So how is this going to have a long-term impact in our portfolio?
I think we balance up our growth value exposures, and I think we're bringing ourselves to be more like FGX in construction. We've got more diversification across managers, more stock picking. We're not as reliant on one or two of the managers, and I think that's a really good thing. And I think we're just repositioning to improve the outperformance going forward and to be more robust in market downturns. I think we were pretty disappointed in the last 12 months that we didn't perform better, given that we've got absolute bias managers there and long-short managers. So,
I mean, there obviously has been a fair bit of change in the last 6 months in the portfolio. So how's this actually going to affect the stock composition?
Oh, we'll just have more stocks. And I think we probably may in our next newsletter come out and talk about how it looks going forward in terms of our allocation to the various sectors, where energy, etc., countries. That might be some information that our investors would be really, really interested in. But look, let's just say we're narrowing the
I mean, I think a lot of our investors are, very much focused on the portfolio performance, but the fact that we have the dividends and the yield.
Oh yeah, absolutely fantastic, right? Because if you look at any of our competitors who, multi-manager, their div yields probably 1% or something like that at most, because we've ensured that we're going to pay a reasonable dividend to investors who need to basically live off the dividend. And
also having a profit reserve helps.
Correct, absolutely.
So tell me, you're an investor in both of these companies. Why do you invest in both of them, and how does it play within your portfolio?
So it sits in my self-managed superannuation fund, and it really plays a sort of core role in my Aussie equities and global equities portfolios because of two things. One, they're very diverse and they're quite different to me just going out and picking one particular manager, so I get a spread of managers. And B, the dividend yield's fantastic. And so, a fully franked div yield like that is really helpful. I might retire soon, maybe not.
As long as you're still on the investment committee. But thank you very much, John, for your time. Thank you.
Thank you, Caroline.